open in Asia and the direction of travel for the day. As I'm sure everybody has seen, oil prices have had a big leap this morning in Asian trade, up 2%, nearly $2, popping above 97. Literally, the hand is nearly on the doorknob of $100. We've already internally at GI Publishing drafted the infograph that oil has hit $100 a barrel. We haven't posted it yet because it hasn't happened yet, but we've created the infograph ready to press the button. It seems, as we asked our viewers earlier in the week, would it happen this week? By a majority, they unfortunately forecast it would. It looks like we're getting close. But my question this morning, and I'm going to kick off with Clyde Russell, Asia commodities and energy columnist at Thomson Reuters, sitting far away in Australia, but nonetheless at the pulse of the oil markets. Clyde, does this feel like it's the beginning of the end of this crisis? And indeed, this is all that Putin ever wanted, was to take the eastern province, to put it nicely, with his collection of Crimea? Or is this the end of the beginning of this crisis?
Well, I mean, I think we're into the realms of speculation as to how we work out what President Putin is actually trying to do. I think he's going to.
I would have to challenge that, because I've never fallen into that category. He's doing exactly what I expected him to do and projected, weeks ago. But nonetheless, go ahead.
Well, what I'm saying is we don't actually have a clue of when he wants to stop. That is not clear. He's made it quite clear that he wants these eastern regions. He's recognized them. He might want to grab more territory currently controlled by the Ukrainian government, which he sees as part of those eastern territories, and then sort of coalesce it all together. That is a possibility. I think the moment we have tanks rolling across a sort of a line of control, and he actually attacks the Ukraine, then we have something quite different to what we got today. Right now, we've got something that is basically a prelude, a starter. And I think, if you look at how Putin has operated in the past, he makes a move, see how it goes down, see if he gets away with it, and see what the reaction is. So I think the reaction from the West in particular is going to drive what happens now. And that, I think, is still very unclear. I mean, at the moment, they're talking limited sanctions, that sort of thing. But I mean, if there's any lesson from history, it's appeasement doesn't work. So if you really want to stop Putin and Russia from doing what they want in the Ukraine, you're going to have to go hard, and you're going to have to go soon. Whether there's an appetite to do that within NATO or the EU or even in America, I'm not certain on that.
And I think there's absolutely no doubt about that. There is no appetite. Appeasement is what it is. Crimea is somewhere distant in the rear view mirror. Kevin Wright, haven't seen you in a while. Welcome back to the table. We have a situated lead analyst, of course, APAC for Kepler. Kevin, despite all the dramas of Ukraine, we have the Vitol CEO on Bloomberg overnight telling us that prices are hitting $100 regardless, and they're staying there. Your thoughts on where this intersects with this already tight market, or are we inflated because of geopolitics?
Excuse me. First of all, nice to see you again, Sean. It's been a while. You're right. Apologies for my absence. Yes. It's nice to be back. Russell Hardy's comments overnight are very interesting. I find it hard to argue with them. World's biggest commodity trader should know something about the world's most important commodity. $100 on flat price. I was looking at the backwardation.
Especially if he's betting long himself, he would have a certain view.
Well, absolutely. But, Vitol are, very savvy operators. And I think his $100 per barrel prediction is pretty much on the money, if not even slightly conservative. I mean, I was actually looking just before we came online at the backwardation, month 1 minus month 6, to show really the underlying strength. And it's at $8.29 a barrel. That's incredible strength. And when you've got that level of backwardation, and we're already at sort of crazy flat price levels, I think, his prediction is completely justifiable. The strength is there, and the physical market is tight. We're not seeing slack in the system. We're not seeing excess supply. Net exports on a global basis are down month on month. So all of these things point to the fact that, it's a tight market and prices are justifiably high.
Let's welcome a new voice at our table, Daniel Rahmat, Senior Energy Security Consultant based in Tehran. Daniel, welcome. It does strike me that given the scale of the geopolitical risk here, oil prices are actually relatively modest.
Hello, Sean.
Good
it's my
morning.
pleasure to be here. Morning. Yeah, actually, I think the fundamentals of the market are showing us that prices in the meantime could decrease if the geopolitical risk did not exist. Based on my understanding, in the near future, the markets are going back to the level of consumption and demand before the pandemic. But we should not forget that countries like Venezuela and Iran and an abandoned capacity of U.S. shale production are waiting for higher prices to come back to the market or removal of sanctions or such geopolitical issues. But at the moment, I think the main driver for the bullish market is the geopolitical crisis in Ukraine. So we should wait for the response of the U.S. and the West for the ongoing crisis in Ukraine, for seeing how it's going on, how it's going to what the drivers are going to make the future prospects of the market.
Sitting in Tehran over these times, does it feel like there will be an agreement on the Iran talks? All of the signs recently have been quite optimistic. And if indeed that does happen, how quickly do you think Iran could ramp up its production?
Everybody is optimistic here, but there are some obstacles that I think are going to be resolved very soon, because I think Iran has no other option than coming back to the table and signing the JCPOA again. And I do not think that Iran has a lot to negotiate or to want, because Iran's bargaining capacity is very, very limited, and there is no assets here to spend, and the people's level of life has significantly decreased. But regarding the Iran capacity for increasing production, there are two issues. Iran has abundant amount of oil and in storage, both floating storage and onshore storage. And I think Iran has the capacity to inject a lot of oil, abundant amount of oil in a very short time to the market. But the main issue is the sustainability of supplying enough oil to the market. At the moment, based on OPEC's latest report, Iran's production is 2.5 million barrels per day, and I think 1.7 of that is consumed domestically in the refineries, and the rest of that is exported to East Asian markets and China in particular as the sole consumer of Iranian oil. And I think Iran will have a chance to increase its production for 1 more million barrels in a very short time. But for more barrels, Iran needs investment in steel industry, which is somehow frustrated because of sanctions.
Clyde, the other part of the commentary by the Vitol CEO and others, but nonetheless, he's the most recent, spoken in the last 24 hours on this, that he sees oil prices staying above $100 for some time. We haven't heard much from the Chinese, although we were expecting there was expectation that once the Chinese Beijing Olympics ended, that Putin would move, and indeed that has happened. But the Chinese have remained rather quiet. Nonetheless, oil prices at these levels, how do you see them impacting China demand, Asian demand going forward, if indeed we stay elevated through the second quarter?
I think it's an interesting risk. No one is really talking about demand destruction as yet. They're thinking that the recovery from the pandemic is sort of locked in, economies are reopening, and everything is looking hunky-dory. But if you actually look at the amount of physical oil flowing into Asia in particular, the region I focus on, it has gone up, it has recovered, and it is sort of getting close to pre-pandemic levels, but it's not running away. And if I talk to, my refinery friends and trading friends in Singapore and that, none of them are telling me that they're actually, battling to source oil. If they want a cargo, it's available. In fact, at the moment, they're trying to, buy as little as they possibly can. And the other thing is, I always say, you got to look at the physical market. Oil bought now is only going to be delivered in April. So I think you run the risk that people are going to try and buy as little as possible. And I already see it in countries like Australia, in India, and several of the other more developing countries. Not that Australia is one of those, but petrol prices and diesel prices are basically almost at record highs for consumers. This is going to impact, particularly in the developing countries where fuel is a major cost. But even in developed markets, you're going to find people cutting back. Already, I know I'm driving less. I'm driving the little car rather than the big SUV because I want to save fuel, because I don't like paying $2 a litre for it. It's not, that's a record high for me. So I think, the demand destruction is possible. Does China really have the ability to stop importing, and use up its strategic reserves? Only at the margin. They're still going to have to import 10 million barrels a day on average. But we did see that they were up to 12 million barrels a day, when they were buying all the cheap oil during the price war and the pandemic. So, that source of growth is gone. So I see it as a kind of steady as she goes situation. I also kind of agree, $100 oil might be here for some time, especially with the political risk. But, that will in itself lead to a fair level of demand destruction.
Kevin, where does that leave refiners in general, Asian refiners, throughput levels, margins, and so forth? Are they looking healthy?
Excuse me. You've obviously got to take out of the equation the impacts of jet fuel on margins overall. But I think, gasoline, diesel margins, naphtha, generally been pretty healthy over the last few months. Naphtha obviously has come under a bit of pressure. Excuse me, there's a bit of oversupply in the ethylene markets that's hurting petrochemical margins. But I think generally, you're looking at fairly reasonable refining margins. I want to come back to a point that Clyde just made about the Chinese, the buying spree, let's call it, the buying craze that happened in sort of April, May of 2020. In response to the price war and the surplus that we saw in the crude market. The impact that had on Chinese inventories was quite interesting, right? We went to record levels of stored crude in China, and that reached sort of 970 or so million barrels and then gradually drew down. But we've started to see a little bit of a build again in the Chinese inventories in the last few weeks. They're up to almost 890 million barrels now, according to our data. And that sort of says to you that, like Clyde says, it's not particularly hard to find crude. It's a relatively tight market. As I said, net exports are down month on month, but generally there is oil there. So that sort of says that this $100 a barrel situation that we've got right now is quite sustainable for a considerable period of time.
Daniel, looking at that point of energy prices, both oil and gas, and Asian demand. I know you have a consultancy in Korea and other countries in the East, but do you think Asian demand does get impacted in countries like Korea at these levels, or the consumption and because of energy security, they maintain all of these levels of imports?
I don't think that the Asian economies like Korea, Japan, and China get impacted by this crisis, at least for a short time. In the short time, they're not going to be impacted by that because, especially in China, they have abundant resources, abundant storage, and but they will need to consider those parts of their economy that could be impacted by the level of prices. But I'm very optimistic about the East Asian economic reconstruction and revival. So I do not think that they will be impacted in the short time.
In terms, Daniel, of the move we saw in recent years by Korea and other countries towards spot markets and spot pricing, particularly around LNG, and trying to get away from the oil index pricing, that seems to have come back to bite them a little bit. I'm wondering what do you think the outlook for that is vis-a-vis particularly LNG and the pricing structure for Asian importers?
At the moment, Korea's main priority is to wrap it up the energy transition progress in the country, and they're investing a lot of money in renewable energies, and they're trying to somehow get rid of coal and such types of polluting energies that they already have. So government in Korea, in terms of regulating, they're making regulations and restrictions on the companies for their policies towards the big picture of the energy policy in the country. So I think at the moment, the policy of fixed prices of LNG and long contracts is not going to be changed, and they're going to continue purchasing LNG from especially Qatar and Australia, and also the United States for fixed prices. And I don't think that policy, because that is a sort of major policy and a strategy policy in the Korean government, they're going to make a change in that. But at the moment, I think the abandoned need of the Korean companies need to be purchased in the market and help. So that policy is a sort of fixed policy. I think the government is not going to make any change of that.
Let's go to the survey question and let everybody else have a view on this thesis of the end of the beginning or the beginning of the end. Does Russia invasion of eastern Ukraine represent the beginning of the end of the crisis? That indeed that's all Putin ever wanted. And there was signals of that early on, you may remember, with that slip by Biden. It's only a little bit of an incursion, then, that's okay. Or is this the end of the beginning to a much bigger crisis as described by our friend Boris Johnson, where he said Russia were planning the biggest conflict in Europe since the Second World War. Clyde, from the point of view of the destination, I mean, the point Daniel made earlier, regardless of the answer to that question, just the survey question, but we have Iran with multiple millions of barrels of capacity potentially coming. We've got Venezuela, of course, still on the sideline, but with the world's biggest oil reservoirs. The ability in terms of sustaining $100 oil, when you have that level of capacity opportunity around the corner, how do those two things go together?
Well, I think the key risk has got to be that there is an interruption to Russian oil supplies to the global market somehow. If that happens, then I think oil prices, $100 is going to start looking cheap. Because I don't think, even if you said to Iran, you can produce and export as much as you like, if you said to Venezuela, you guys are good to go as well, I don't think that really replaces, what we would lose from Russia. And then you have to, there'd be supply rationing. There just wouldn't simply be enough oil around. So what I would look at as the key is just if the conflict does escalate from here, and I don't expect it to be a rapid thing. I expect Putin to take little chunks and little bites and see how far he can go and see how more he pushes it and what reaction he gets. I mean, this could drag on for months. He doesn't care. Right now, he's still exporting all these gas. He's still exporting all his oil, his other commodities like nickel, aluminium. They're all still leaving Russia, and they're making lots of money on them. So the longer he runs this crisis, for him, in some ways, actually, the better. It's only when the level of pain for him and his inner circle becomes too much, or there is a threat that those very commodities will be sanctioned, that there might be a shift in his thinking. But so far, there's no sign of any of that. So at the moment, if you actually think of we are still getting all this oil, eventually you'll probably end up with a stage where we actually have enough supply, especially if OPEC Plus manages to actually produce the extra 400,000 barrels a month every month, something it hasn't done up to now. So, there will come a time, assuming that Russian oil still flows, assuming Iranian oil or some more of it comes back, even assuming some Venezuelan oil comes back, there'll come a time when there's actually too much oil and $100 barrel will be unsustainable. But the point is that time is still, it could be several months away. The longer Ukraine drags out, the more people will remain nervous. The more $100 oil looks like something that's going to persist or get to and persist.
Kevin, I mean, on that point, we are, as was mentioned earlier, trading into April or for April delivery, so into May. We're already into the sort of spring delivery, coming out of the peak demand period of the Northern Hemisphere, and the softer demand window of the year, refinery maintenance and so forth, that this event is sort of culminating into that somewhat of a weak vortex. And perhaps that's why we're not seeing a bigger spike than current.
Crude's up by $2.25 overnight. How big a spike do you want?
Well, we're talking about a country being invaded in Europe. I mean, this is not a minor event. $2. No, we've been moving up and down $2 quite regularly in the last few weeks.
Well, this is true, and I mean, that volatility has become very much a sort of a hallmark of the current market, right? I mean, we've seen it, as you say, $2 here or there. A country's been invaded, and we see another $2 move. So it's just yet another feature of the market. Like I said, it's a relatively tight market. Clyde's point's absolutely spot on. There is oil there if you want it, but fundamentally, yeah, we're in a position that does support these prices. And I think if it escalates, again, I have to agree with Clyde. $100 in a few months' time might look cheap.
It's also a day, Kevin. I'm not quite sure if you're still sitting in London or Singapore. Actually, I should have said that earlier. But today is the day the UK have abandoned all rules regarding COVID, essentially saying if you get COVID, you don't even have to quarantine. Never mind if you're in a close contact. That seems to be at the start of a trend in Europe and elsewhere, America. Your thoughts on that and its impact, again, to add to the demand tightness?
Yeah, I, for one, I'm really grateful and really glad that we're on this day. We've talked about this for a number of months, a number of years now, renormalization, right? We've talked about accepting the endemic as it is. And I've sort of made this point that, humanity has created this crutch of vaccination and we need to lean on it. And that's what the UK effectively is doing, right? It's taking a leading position. I'm actually in Dubai at the moment, but I'll be back in the UK next week. Yeah, just down the road.
Well, welcome then.
Thanks very much. We should meet for a Guinness sometime.
Yeah, exactly.
But I do think, we have been waiting for this day, this sort of evolution, this development for a long time. And it's exactly the right sort of situation to be in. People are not having the same symptoms they had before. It's not as serious as it was. I accept as well. I'm not sort of throwing caution to the wind here, and I'm not dismissing it. There are still deaths. But we still need to understand that, there's perspective and there's context.
But without going down the rabbit hole of COVID politics, from a demand point of view and mobility and aviation fuel, I mean, you said earlier you have to discount aviation, the outlook on those things.
Well, that was specifically aviation fuel in the context of Asian margins.
Okay.
Because Asian countries are not opening up as quickly as sort of Europe and the US, and therefore aviation demand is going to still struggle. But in the UK, in the US, I would expect gasoline demand to start recovering. I would expect pretty much, every clean product demand to start recovering, and we will start to see a renormalization. So it's all, I think, all relatively positive from here. Extra
reason for that tightness, putting aside the crisis in Ukraine. Daniel, similar and curious, we haven't often got insights from the streets of Tehran, so to speak. How is COVID there these days? How is the sort of economy performing under the weight of the COVID protocols? I mean, but there's many other things affecting the Iranian economy, but ultimately COVID in Iran.
Actually, COVID at least in the first year damaged the Iranian economy severely, and the trade with the neighboring countries was very limited, and there was serious restrictions, especially in the air travels and so on. So there was problems with the Iranian economy at the first. But as you know, Iranian new government, the Raisi government, was established something about 100 days ago, and
100 years
they
ago.
years ago.
Feels like 100 years, but it's only 100 days.
Yeah, it's 100 days ago. Yeah, exactly. It feels like 100 years. And they really do not believe in COVID restrictions. And despite the country is in the peak of the Omicron variant of COVID-19, they have put no restrictions on travels or even concerts, and life is back to its normal way. But you know, the toll of the deaths has significantly decreased because of vast vaccination during the last months. But the number of infected people has increased very much because of the Omicron variant right now, and I think that is going to get to decline within 2 weeks, and within 2 weeks the country is probably going to get to the peak. But the economy, since the economy since the new because of the new variants impacts was not significantly changed. I don't think it had any serious impact on the economy, and everybody is waiting to see what's going to come out of the JCPOA. So that the JCPOA news is the main driver of the markets and exchange rate and blah blah. Yeah,
Daniel, may I just ask you just on that JCPOA and coming back to the oil story and the ability to rehabilitate production in Iran, mm-hmm. How significant a challenge will the availability of water be? We know Iran is suffering very severe water shortages, and how can that impact industrial operations, agriculture, of course, we know, but in terms of the rehabilitation of Iran's oil sector?
Iranian agriculture sector is the main problem in the Iranian water crisis. During the last 4 decades, the Islamic Republic was always emphasizing on producing as much agriculture products as possible. So the area of agriculture areas has increased significantly, and is much more than the natural capacity of the country. So the main problem and the main driver of this problem is the agriculture sector. More than 80% of Iranian water consumption is in the agriculture sector. And because of the very old methods and somehow underdeveloped technology of agriculture, the volume of water they consume for a certain tonnage of agricultural products is much higher than the world level. So I think the problem is not going to, there is no threat going for the Iranian oil industry because of water shortage, and also the petrochemical industry is not going to be impacted by that. I think these industries, especially the petrochemical industry and electricity generation industry, are more threatened by lack of natural gas. You know, despite the country is the second natural gas reservoir holders, the main crisis at the moment in the country is natural gas, not the water.
Interesting. Let's get the survey result and give Clyde the last word this morning. End of the beginning, 2-1, not an optimistic room here. Batten down the hatches, $100 oil. Here we come. Clyde, obviously, today's a big day. Depending how the reaction goes, I suppose depends on whether we keep, instead of it being a $2 day, maybe a $4 day. Your thoughts on that?
I think, yes, you're right. I think in some ways the markets actually appears to me to be having quite a mature reaction to all this. They're looking at it and saying, well, the oil's still flowing, the gas is still flowing, we're still all okay. But yes, we're really worried about all this. I think you've probably got a $10 premium in the barrel of oil at the moment for geopolitics. And, you know, if the things tend to get worse, then that premium will rise. But, you know, if we sort of, you know, de-escalate for a bit, like I say, I think this crisis is going to run for quite some time. It's certainly in Putin's interest to do so. And he hasn't got all he wants yet. and he's going to see if he can. So to my mind, yes, it's not been a very big move for the scale of what has actually happened, but we don't really know what the next stage is. This is not like a Germany invading Poland moment where we knew the next stage was World War. That was a very clear thing. Those lines in the sand haven't been drawn as yet. So what we're going to see likely is America and the Europeans impose some kind of sanctions that will be more slap on the wrist, annoyance sanctions. They're not promising the big ticket items yet. And, at the moment, that means oil and gas will still flow. So $100 a barrel seems about the right for the current sort of situation. But, yes, you just got to watch and see what happens. And, we all have a feeling of what may happen, but we don't really know.
Well, I think it's certainly in a way the frog being boiled in the bath water, slowly getting hotter and not really knowing if this is a crisis or not, and perhaps all of the warnings by Biden, it's going to happen, it's going to happen, it's going to happen, it's going to happen, and finally when it happens, the news, if you like, is not of such impact because the markets have been insulated by this constant Boris and Joe barrage of imminent danger. But I think the West ultimately is willing to give up Donbass as they did Crimea, and that perhaps is the red line. And we'll see if Putin is satisfied. But as the saying goes, I think we had one of our commentators on the air here, Christoph Ruhl, a long time BP working in Russia, told a story that of the wolf. The wolf will feast, it will then rest, and then it will come back to feast again. So we'll see where that lies today in terms of the Russian bear or the Russian wolf feasting on eastern Ukraine. Will it be satisfied? Clyde, thank you so much. Great to have you. Kevin, great to see you. And Daniel, thanks for joining us. We look forward to having you back. Have a great day, everybody. A big day. We'll see if we'll be posting that $100 oil infograph in the coming hours. All the best.
Thank you. Cheers.